Thank you for joining me. In this video, we are going to look at the recognition and measurement. So recognition means my first journal entry on what day, and measurement will be at what amount. So what happens from the lessee's perspective? Remember, the lessee is the entity that will receive the right to use the asset for the period of time, the lease term, and in exchange for the right to use this asset, they will have to make payments. Legally, they will not be the owner of the asset, and they are not required to take ownership at the end of the lease term. However, the substance of this agreement and the financial reality is that the lessee obtains the right to use the asset to generate future economic benefits for themselves over the lease term. So how will this lease agreement then be accounted for by the lessee? Lessee, entity who will receive the right to use the asset. We will debit a right of use asset in our books, and we will credit a lease liability. So this will be our liability to make the future lease payments. So on the statement of financial position, it will be for all assets leased by all the lease agreements, except if a company will elect one of two recognition exemptions. So this means in certain circumstances, a lessee does not have to recognize a right of use asset or a lease liability. And it's an election, so they can choose, do I want to use one of the two recognition exemptions or rather not? So a lessee may elect, so may choose not to recognize an underlying asset or liability, so not recognize these two, the right of use asset or lease liability, for leases of 12 months or shorter, so short-term leases, or then for leases for which the underlying asset is of a low value. So this will be, for example, computers, tablets, laptops, small items of office furniture. This is also known as the simplified accounting approach. And here you can see where in the standard must you go and tag and flag your exemptions. So let's dive a bit deeper into the two exemptions. For short-term leases, the option to extend or to terminate a lease that is reasonably certain to be exercised should be considered in determining if the lease term is 12 months or less. So that makes sense. For example, if we are reasonably certain, so our non-cancelable period, for example, is a year, but we are reasonably certain that we will extend the lease for another year, then the lease term is not 12 months or less. If there's a purchase option, then it's not a short-term lease because there's a chance that we will actually buy the asset and then have the asset forever. If a lessee elects this exemption, it has to be made by a class of underlying assets. For example, if they selected this exemption for a delivery vehicle, then it will be for all the delivery vehicles where they have a lease agreement with. Any subsequent modification or change in a lease term shall be accounted for as a new lease. However, modifications is not included in the third year syllabus. If we talk about the low value underlying assets, then to determine if the value is low, we have to look at the value of this asset when it was a new asset. So regardless of how old it is now, is the value of this asset when it was new, was it low value or not? So therefore, because a new vehicle is not a low value asset, a vehicle is never a low value asset. This assessment, however, is not the same in terms of short-term leases, where short-term leases will be for the class of the underlying assets. Here it is on a asset by asset basis. So it's not done on an aggregate basis. It's also performed on an absolute basis, so it's not affected by the size, nature, or circumstances of the lessee. We won't take into consideration, for example, materiality. Maybe the asset is material in terms of the lessee's financial statements. However, we do not look at that. We look at what the standard is saying, what is low value or not. In the next slide or video, we will look at how we will account for these two exemptions.